Welcome back to the deep dive. Today we're not just glancing at the price of Bitcoin, we are pulling out the full toolkit, the microscope, everything, and doing a full system diagnostic.
Yeah, that's the right way to put it.
Our mission is, well, it's very direct. We're diving into a highly specialized, multi-time frame chart analysis that focuses entirely on just the massive volatility we've seen.
The whiplash.
Exactly. Specifically that violent correction right after its recent price peak.
This is really a deep dive that's, it's tailored for you if you're a listener who gets the headlines. They just don't tell the full story. They barely even tell half of it.
Right.
You need to get to the technical truth that's buried underneath all that noise.
And the source material we're working with today is, it's dense, let's be honest. It relies very heavily on technical indicators, mostly moving averages, but it looks at them across three completely distinct but connected timescales.
That's the key. We're looking at the weekly, the daily, and then the really short-term 4-hour charts.
And the genius of this approach, this multi-time frame thing, is that it acts like a filter, right? It helps you make sense of the chaos.
It does. When you see a terrifying 10% drop on your hourly chart, you have to know if that's a real trend reversal or if it's just, market noise designed to shake you out.
So our goal here is to equip you with the knowledge to see the difference between, say, the long-term conviction that should probably keep your hands steady and the short-term uncertainty that, frankly, demands extreme caution right now.
Exactly. We want to show you precisely how these different time frames are creating a conflict, a crossroads for Bitcoin right now. And you need to understand why a number like $102,000 isn't just a round number.
It's not arbitrary.
Not at all. It's the psychological and technical linchpin that connects that huge macro trend to the tiny micro fight that's happening as we speak.
So I guess the central question for this entire deep dive is this. How do we reconcile these conflicting signals? You have this really strong weekly uptrend, but then you have this immediate, pretty scary weakness on the daily chart. What are the key levels that Bitcoin has to hold or, completely shatter to tell us if this correction is finally over or if we should all be bracing for another big leg down?
Let's unpack that. It's a critical question.
Okay, let's do it. So to unpack this, we have to start by, establishing the bedrock. Any serious analysis has to begin with the broadest possible context just to avoid those short-term emotional traps we all fall into.
Absolutely. You have to zoom out first.
So we're diving first into section 1. The macro picture long-term conviction. And we're defining that by looking at the weekly or 1W frame. This is the chart that tells us if the whole party is over or if we're just, taking a quick break.
And the weekly frame is fundamentally reassuring. I think that's the main takeaway. Even after all the severe price action we've seen, the big conclusion from our source material is really firm.
Which is?
The large trend remains a strong uptrend. It has not been broken. And this resilience, it suggests that the underlying structural forces that are driving capital into Bitcoin, they're still there. They're intact.
So the big money sees this volatility as corrective, not terminal.
Exactly. It's a correction, not a catastrophe, at least on this time frame.
But, conviction needs proof. It needs technical proof. It can't just be a gut feeling that things are going to go up eventually. So what indicators are actually confirming the durability of this macro trend, even with the recent crash?
Well, the proof is really in the relationship between the price and these long-term moving averages. Specifically, the Bitcoin price is still trading, and pretty comfortably, I might add, above both the MA50 and the MA99 week lines.
Okay, now for anyone listening who's really into the technicals, the source analysis seems to be using exponential moving averages here, or EMAs, right? Not simple moving averages.
That's right, and it's a really important detail.
So walk us through that. Why is that specific detail so important? Why EMAs over SMAs in this case?
It all comes down to responsiveness. An EMA, an exponential moving average, it places a greater weight, a greater importance on the most recent price action.
So it reacts faster?
It reacts much faster. It makes it more sensitive to volatility, and it gives you a more timely assessment of where the current structural support is compared to a simple average that treats all data points equally.
Which, for something as volatile as Bitcoin, seems pretty essential.
It's critical. With Bitcoin, using the EMA 50 and the EMA 99 gives you a highly relevant gauge of where the average long-term investor's entry point probably is. And if the price stays above those lines, it means the vast majority of long-term holders are still in profit.
And that reduces the incentive to panic sell.
Drastically. It means their confidence is still high, and that confirms the trend's durability.
Okay, so that covers the structural stability of it. What about momentum? Did this huge correction just kill all the upward energy on the weekly chart?
You know, it's funny you asked that because the weekly chart actually printed a very compelling bullish signal, even as the price was correcting.
Really? What was that?
We saw the shorter-term momentum line, the MA7, successfully cross up and over at the MA25 line on the weekly. Now, this is a significant mechanical event.
So the 7-week average price overtook the 25-week average.
Exactly. In a long-term context, that crossover, it's interpreted as a signal that the bullish momentum engine just got a fresh tank of fuel. It really reinforces this idea that we're in a pause, not a full-blown reversal. The market is trying to re-accelerate to the upside, even if you can only see that acceleration on this macro scale for now.
Let's zero in on the price action itself. We're talking about Bitcoin hitting a really aggressive high. The source pins that peak at $126,190. That was the moment of, euphoria.
It was. And as is just inevitable in any market, euphoria is always followed by a necessary correction. So the price pulled back hard, and right now it's sort of consolidating in that $107,000 to $109,000 region.
Right, but you brought up a great point earlier. At what point does a massive drop stop being a normal adjustment? I mean, I have to press you on that.
Please do.
A drop from 126,000 all the way down to 93,000, which we'll get into, that's a loss of over 25%. I mean, for a lot of traders, that is absolutely devastating. How can we justify calling that normal?
It's justified by looking at magnitude versus context. Previous bull cycles for Bitcoin, corrections of 30, even 40% were extremely common.
Right. They were almost expected.
They were necessary even.
Right.
They were necessary to shake out the excessive leverage and just reset the speculative fever that builds up around a peak like 126K.
So this dip, in a way, was healthy.
It was. This particular dip, it successfully flushed out all that short-term speculative leverage, which ultimately creates healthier price discovery in the long run. So as long as the price holds above those long-term EMA supports we talked about, the MA50 and MA99, the structural integrity of the bull market is intact. The dip, however painful, it probably serves to extend the life cycle of the overall uptrend.
Okay, so the trend is intact. But we need to know the point of no return for this weekly structure. Where is the absolute critical support zone that simply has to hold?
The analysis points to an immediate hard price region for strong weekly support, and that's between $99,000 and $102,000.
Okay, so right around that big psychological 100K number.
Exactly. It's a powerful zone because it combines recent price history with that huge psychological barrier of $100,000.
And there's a crucial nuance here from the source, isn't there? It explicitly points out that while the historical MA99 support line might actually be way lower, maybe near 63,000, the market doesn't seem to care about that historical average right now.
That is such a key distinction. It separates, real technical analysis from just mechanical trading. The market has a very short memory for distant averages when it has recently fought a major battle somewhere else.
So memory is focused on recent congestion zones.
Precisely. Because of how fast the price shot up to 126K, the strongest structural support has also moved up very rapidly, and it's settled in that 100K to 102K region. This means we can't really rely on a floor way down at 63,000. We have to rely on the immediate floor that's been established by recent institutional buying interest.
So losing 102,000 would be a much bigger deal, much faster than testing 63,000.
Oh, a much bigger deal. Losing 102K would immediately bring the entire macro picture into serious question.
So really, establishing this weekly view is less about predicting the exact future and more about giving yourself a psychological anchor. A map that says, okay, you're still on the right road despite this really bumpy temporary detour.
Exactly that. It's the difference between seeing a road sign that says slight curve ahead and panicking because you hit a small pothole. The weekly chart tells you the road is still heading north, and all the daily chaos we're about to look at, it's just a temporary fight for momentum. It's not a total market failure.
All right, with that macro foundation firmly established, green light, strong uptrend, let's put a spotlight on the immediate problem. We're moving into section 2, the critical short-term conflict, and this is defined by the daily or 1D analysis.
And the source material calls this the most important frame for figuring out what's going to happen in the next few trading days. This is where all the red flags are flying.
It's a huge contrast with the weekly chart.
A very sharp contrast. The daily chart tells the story of the crash. We have to really detail the sheer velocity of that price decline. It was a sharp, rapid move from that $126,000 peak straight down to the recent low of $93,005.
So this wasn't a gradual slide, it was a cliff.
It is a cliff. It represented a very concentrated short-term liquidation event, a cascade.
And since hitting that 93K low, what have we actually seen?
We've seen a slight, I would call it a tentative recovery bounce. The price is kind of hovering in that $95,000 to $96,000 range right now. But, and this is a big but, on the daily time frame, this recovery looks incredibly weak.
Why?
Because the technical indicators are just screaming caution.
Okay, let's detail those short-term bearish indicators.
Mm.
Where does this conflict on the daily chart really show up?
It's defined by the classic moving average setups. First off, the short-term momentum, which is the daily MA7, is now positioned definitively below the daily MA25.
And that crossover downwards, that's a big deal.
It's a critical sign of what we call momentum inversion. When the average price of the last 7 days is less than the average price of the last 25 days, it's a confirmation that bearish pressure has completely taken over the immediate trend structure.
And the longer daily average, that confirms how severe this weakness is.
Precisely. The price is also currently sitting below the daily MA99. Now, you should think of the daily MA99 as the medium-term structural support.
The main floor for this time frame.
Yes. And cracking below that line, it indicates that the sell-off was substantial enough to put serious pressure on medium-term holders. So this tells us that even though the weekly trend is strong, the daily structure is compromised. It's a temporary reversal of momentum, but it's a serious and sustained pause in the market's immediate journey upward.
So if we synthesize this conflict, you have macro strength versus medium-term weakness. It tells us that while the big money conviction is still long-term bullish, the tactical traders are the ones holding all the cards right now.
That is the perfect summary.
And they're demanding confirmation before they jump back in.
Exactly. The institutional investors, they're sitting on their hands. They're waiting for the daily momentum to confirm the weekly conviction. And until that happens, the short-term bears have complete technical dominance.
Okay, so we need the precise boundaries of this conflict. Let's establish the key levels that are going to dictate movement on this daily chart, starting with the floor. Where's the absolute bottom for now?
The floor is that recent low, established at $93,000. That is the immediate crucial support.
And what if it breaks?
If the market cracks that floor, so if we get a decisive daily close below 93K, the source analysis warns that the next major testing area will be $89,000 to $90,000.
So a failure at 93K is a major risk trigger.
It is. It implies another $3,000 to $4,000 downside acceleration, and probably very quickly.
Okay, that's the downside. What about the immediate ceiling for this bounce? What's the first hurdle that would prove this daily recovery has any strength at all?
The first significant resistance is at $90,000. And this level is highly significant because it aligns almost perfectly with the MA25 line on the daily chart.
Ah, so it's dynamic resistance.
Exactly. And as we know, dynamic resistance from key moving averages is where bounces very often stall out and reverse. So a rejection at 98K would signal that this short-term downtrend is far from over.
And then there's the ultimate level, the one you call the technical and psychological bridge that separates a correction from a real recovery.
That would be the $102,000 lever. It's the most critical resistance point in this entire analysis. We're calling it the synthesis point because of this incredible convergence of factors.
What's converging there?
Well, it represents the high end of that weekly macro support zone we talked about, the 99 to 102K zone. And it is the decisive resistance that needs to be broken to confirm a daily uptrend reversal.
So if you're an institutional buyer, what does reclaiming 102,000 signal to you?
It signals confirmation across multiple timeframes. Reclaiming 102K means the daily chart has officially broken through major resistance, and at the same time, the weekly chart has successfully defended its most critical support zone.
It's the all-clear signal.
It is. It confirms the shakeout was successful, that the bull market is ready to resume, and that the $93,000 low was the definitive bottom for this whole correction. But until that level is broken and held, institutional capital is going to stay cautious.
The daily trend conclusion is pretty clear then. The current bounce is not structurally sound.
Correct. The analysis states that Bitcoin is currently recovering, but, and I quote, lacks sufficient strength to confirm a reversal. For a return to a strong uptrend, we need unambiguous price action.
No maybes.
No maybes. Either a decisive break and hold above that immediate momentum resistance at 98K, or the ultimate reclaim of macro stability at 102K. Until then, daily momentum is paused or, reversed.
This tension, this inherent tension between the daily weakness and the weekly strength, is why we have to look at the fastest time frame to see the tactical maneuvering that's happening right now.
Yes.
So we're moving into section 3, the immediate action, focusing on the technical bounce that's showing up on the 4-hour or 4H frame. This chart tells us about the immediate buying pressure.
The 4-hour chart is where we get confirmation of that tactical base. It confirms the formation of the recent bottom at $93,005.
And what does it show since then?
Since that low point, the chart has shown consecutive green candles. It's a very clear visual sign of buying pressure, pushing the price up toward that $95,600, $95,700 range. This is the very definition of a technical bounce. It's a predictable, mechanical reaction after a steep sell-off.
And is there a technical signal that confirms this bounce has some momentum on this short-term scale?
Yes, there is a clear short-term bullish signal. The MA7 has crossed above the MA25 on the 4-hour chart.
Okay, so the opposite of the daily chart.
Exactly the opposite. This is the first positive momentum shift we've seen in days, and the source cites it as a clear sign of a technical recovery. For short-term traders, this crossover offers the first real justification for taking a tactical long position, targeting that next resistance level.
But this immediate recovery, as fast as it comes with a structural caveat, right? Even on the 4-hour chart, it's not a sign of full health.
Absolutely not. We have to recognize the limitations of this bounce. The MA99 line on the 4-hour chart is still positioned higher than the current price action.
And what does that tell us?
It's the detail that prevents us from calling this 4-hour trend strong. It signifies that while the immediate momentum, the MA7 over the MA25, has turned positive, the medium-term trend on this chart is still struggling to get its footing. It hasn't regained structural integrity.
It's like a car that just got pushed out of a sand trap.
That's a great analogy. It's moving again, but it hasn't hit full speed and is not ready for the highway.
So the immediate trajectory, according to the source, is pointed directly toward that first major collision point.
Yes. The short-term recovery is predicted to continue up to maybe the $96,500 region. That's likely where some early tactical buyers might start taking initial profits. But the primary high-stakes target is that major resistance at $98,000.
And that $98,000 level is where the 4-hour story meets the one-day reality.
It is the perfect technical confluence. You have this fast 4-hour recovery momentum charging straight toward the heavy daily MA25 resistance. This creates a powerful selling wall.
So if the price manages to break 98K?
If it breaks 98K, then the 4-hour momentum has successfully overpowered the daily weakness, and the path to $102,000 opens up pretty quickly.
But what happens if the price gets rejected at 98,000? Which, it seems like a high probability given the low conviction we've talked about.
If the price is rejected, so if that buying pressure just stalls out or is completely overwhelmed by the daily resistance, the analysis suggests Bitcoin will immediately turn back down. The failure of this tactical bounce would lead to a very swift retest of that $93,000 support level.
So that's the fundamental risk.
It is. The 4-hour frame confirms some short-term hope, but that hope is highly conditional. It's running headfirst into a much more powerful, higher time frame resistance. And the failure rate at major resistance levels during a confirmed downtrend is, statistically very high.
This brings us to section 4, synthesis, risks, and scenarios. We have these 3 different perspectives, the long-term, the medium-term, and the immediate action, and we have to synthesize them into a cohesive plan.
Let's use that traffic light system to summarize this crossroads clearly for you.
Okay, let's do it.
The long-term, the 1W scale, that's a green light. The foundational uptrend is strong and it's unbroken, so that should provide you with long-term conviction.
Then the daily.
The medium-term, the 1D scale, that is yellow bordering on red. The trend is currently down, and this tactical recovery bounce is completely unconfirmed. This is the warning light about immediate danger.
And finally, the 4-hour.
The short-term, the 4H scale, is blue. We'll call it blue to signal a definite technical recovery is underway, and it's likely to continue up to that $98,000 resistance.
Okay, so we have a clear map, but now we have to talk about the hazards on the road. What specific market risks are being amplified right now, according to the analysis?
The analysis highlights 3 crucial, and they're all interconnected, risks that make this period exceptionally difficult to navigate, even for professional traders.
Let's start with volume. The source notes that trading volume is currently decreasing. Why is that such a major red flag?
Declining volume is it's perhaps the biggest danger sign here. It suggests that all this recent sharp price action, both the drop and the current bounce, is being driven by thin order books rather than real conviction.
So what does that mean in practical terms?
Think of it this way. A massive breakout on high, increasing volume that confirms institutional conviction. The big players are buying in. But a recovery on low volume, like the one we're seeing now, suggests that only retail traders or maybe short-term algorithms are participating.
So if low volume is driving this bounce, how does that make the market more unstable?
It means the move is fundamentally hollow. It's fragile. It massively increases the risk of a reversal because it takes very little selling pressure from one determined entity to completely wipe out all the low-volume upward movement. A simple rejection at 98K on a sudden spike of selling volume could send the price tumbling much faster than if the bounce had been supported by stronger participation. Low volume equals high manipulation risk and very low conviction.
Okay, risk number 2 is the MA failure that we detailed on the daily chart.
Yes. The failure to reclaim those longer daily moving averages remains a systemic weakness. Until Bitcoin moves back above the daily MA25 at 98K and the daily MA99, the market is structurally in a downtrend on the medium-term chart.
We're fighting against gravity.
You're fighting gravity. Any capital that's entering the market now is entering against the prevailing medium-term technical structure, which is just inherently risky.
And the third risk, this deals directly with the volatility, these huge high-amplitude swings. We need to talk about traps.
Yes, the source notes that this large range of fluctuation, it maximizes the risk of both bull traps and bear traps. This is where market psychology and technology really intersect to cause pain.
Let's spend a minute just defining those traps clearly in the current context. What does a bull trap look like right now?
A bull trap is highly probable right now. So imagine the price pushes up to $97,000. Traders who've been waiting for the bounce, they see the green candles, they see that 4-hour MA cross, and they think, this is it. The bottom is in. Time to buy.
FOMO kicks in.
Exactly. They jump in, they go long, right before the price slams into that $98,000 daily resistance wall and is just violently rejected. The price then crashes back down to $95,000 or even lower, and it traps all those new buyers in instant painful losses.
And the psychological damage there is huge.
Immense. Your confidence is destroyed, and all those trapped buyers, they become forced sellers on the next little drop, which just adds to the downward pressure.
Okay, and the inverse of that, the bear trap, how does that apply here?
Well, the bear trap likely already occurred. It happened when the price briefly crashed below $93,000 to hit that $93,005 low.
I see.
Short sellers, who were convinced that the crash from 126K was going to continue straight down to 89K, they entered short positions, betting on that breakdown. But because 93K acted as psychological support, the price immediately reversed and bounced upward toward 96K.
Squeezing them out.
All those short sellers were instantly liquidated or forced to cover their positions at a loss, and that covering, that buying, provided the fuel for the technical bounce we're seeing now. These high-amplitude swings, they just maximize the effectiveness of these traps. They punish emotional decision-making.
So with these major risks, established low volume, structural weakness, and active traps, let's move to the prescriptive part. The near-term scenarios, based on the source's probability weighting.
And we have a very interesting probability distribution here. The source gives a 40% chance of continuation up, a 30% chance of sideways movement, and a 30% chance of decline.
Okay, so the key insight there is that the combined risk of going sideways or down is 60%.
That's it. It's signaling that the path of least resistance right now is not straight up. Caution is absolutely warranted.
Let's detail scenario 1, continuation up. At a 40% probability, what has to happen for this to play out, and why is the probability only 40%?
The 40% probability is based entirely on that existing short-term 4-hour momentum being strong enough to overpower the daily weakness. The action requires Bitcoin to successfully break and, importantly, hold the $98,000 resistance.
And if that happens?
If that happens, momentum shifts decisively. The target instantly becomes that $102,000 level. And the critical outcome is this. If 182K is surpassed, it triggers a return to a strong daily uptrend, it validates the weekly strength, and the correction is officially over. But the probability is only 40% because of the low volume and that powerful technical wall at 98K.
Okay, scenario 2 is sideways movement at a 30% probability. This is the classic period of market indecision, the chop.
And this scenario is highly probable, given the current low volume and the very clear boundaries that have been established by this technical conflict. It predicts that Bitcoin will just consolidate, bouncing between the critical support at 93,000 and the immediate resistance at 98,000.
A trader's nightmare.
It's a necessary cooling off phase, but yeah, it's a nightmare. It's where traders wait for fresh institutional capital or some big news before they commit to a major directional move. If this happens, you should expect just whipsaw action that burns capital very quickly if you're trying to day trade that tight range.
And finally, scenario 3. Decline, also at a 30% probability. This is the downside risk materializing.
This scenario is triggered by the failure of the current technical bounce. So if Bitcoin is rejected anywhere between that $96,000 to $98,000 resistance zone, it signals that the daily downtrend remains dominant.
And the price heads back down.
It immediately turns back down to test that crucial $93,000 support level. And if that floor breaks, the probability of hitting the next support zone, 89 to 90,000, becomes extremely high. That 30% downside probability is really driven by the structural weakness of the daily MA failures and the danger of that low-volume bounce just exhausting itself at resistance.
So if we look at that distribution, the analysis is strongly suggesting you should wait for confirmation. Betting on an immediate clean breakout is actually the lowest probability outcome right now.
Absolutely. The odds slightly favor caution, observation, and waiting for the market to resolve the conflict at those key levels, rather than trying to predict which way that $98,000 wall is going to break.
This careful technical assessment has to be translated into practical guidance. So we move now to Section 5, Traditional and Safe Advice. We're translating all this technical knowledge into actionable risk management strategies.
And the primary takeaway here, it really focuses on discipline. We have to reinforce the anti-FOMO rule. The explicit advice from the analysis is, and I'll be blunt, do not buy while the price is only recovering and has not yet decisively broken a strong resistance level.
Which means waiting for the break above 98K, or even more safely, 102K.
Ideally 102K.
We've established why it's dangerous low volume, high risk of a bull trap at 98K. But what specific technical risk management approach should you be taking instead of just rushing in?
Well, let's say you're highly conviction bullish based on the weekly chart. The only safe technical entry point during this recovery period is after the price has reclaimed 98,000 and shown it can hold it as support.
Right.
Or ideally, you wait for the $102,000 confirmation.
And if you do enter early?
If you insist on entering early, sound risk management just dictates using that $93,000 level as an immediate, non-negotiable stop loss. A break below 93K invalidates this whole technical bounce, and it confirms the downside scenario, scenario 3. That requires an immediate exit. Trading without a stop loss based on that 93K anchor point is, well, it's simply gambling during this period of high volatility.
So the technical analysis provides the road signs, and the sound advice ensures you're wearing your seatbelt. Which brings us to focusing your attention. We have 3 numbers that basically dictate everything.
That's right. All the complexity of this multi-time frame analysis, it all boils down to focusing your attention on just 3 critical, non-negotiable key levels: 93,000, 98,000, and 102,000.
Let's just solidify their roles one last time for everyone listening.
Okay. $93,000 is the hard floor. It's the failure point of the immediate bounce. $98,000 is the first major ceiling. It's a daily momentum resistance. And $102,000 is the technical bridge. It's the ultimate gate to macro stability and daily uptrend confirmation.
So every strategic move, every entry, every exit, it has to be calibrated against the market's reaction to those 3 levels.
It has to be.
Finally, we have to touch on psychological resilience. The sheer amplitude of this move from 126K down to 93K, that can trigger deep emotional responses, and that leads to very poor decisions.
And it is so vital to, as the source says, maintain a stable state of mind. You have to internalize that these severe market fluctuations, they aren't random acts of fate. They are normal mechanical events that are designed to shake out weak hands and rebalance market leverage, especially after a strong euphoric peak.
The market preys on emotional volatility.
Constantly. It preys on the fear that causes panic selling at 93K and the greed that causes FOMO buying before 98K is confirmed. Sound psychology is the firewall between the technical map we've created and, emotional self-sabotage. You have to trust the technical boundaries and do your best to ignore the emotional noise.
This has been an incredibly detailed breakdown of the technical landscape. Our core insight seems to remain pretty consistent. Bitcoin isn't a necessary deep correction, but it's securely nestled within a strong weekly uptrend.
Hmm.
The immediate issue is the lack of volume and these formidable resistance walls at $98,100 and $2,000, which must be decisively overcome to prevent a further drop toward that $89,000 to $90,000 range. The market is just waiting for confirmation above 102K.
And as we conclude this deep dive, let's just leave you with one final thought built directly on this convergence we've analyzed today.
Go a little deeper on that synthesis point for us.
Consider the full implications of that $102,000 level. It perfectly encapsulates the current market narrative. If you're a long-term bull, you view $102,000 as the top of your weekly support zone. It's the highest point at which the market must defend its structure.
Okay.
But if you're a short-term trader or a potential new entrant, you view $102,000 as the highest hurdle. It's the point of required daily resistance you have to see broken before you can trust the uptrend again. This price point, it's not a technical coincidence. It is the literal battleground where the confident, patient macro capital will prove its conviction, and where the skeptical short-term capital will finally be forced to capitulate.
So which side of that number wins?
Whichever side of $102,000 Bitcoin settles on will not just dictate the next few days of trading, but will likely confirm the trend direction for the rest of the quarter. Watch that number very, very closely.
Until the next deep dive, stay informed and manage your risk.